This is Nathan Gendelman along with Joe Lamond, and welcome to our spring family firm investment call. Just to let you all know, what we end up doing, just because it makes it easier for everyone, is just to kind of mute the listeners so that there's not a lot of background noise, and then we'll come back and ask for questions or just thoughts, and then we will, throw the floor open to everyone. So if that's okay with you, we'll just do that, and then we'll come back for questions after I'm done with my soliloquy. So thanks again, and good evening. Just kind of how we generally do these, I just start off with a few thoughts. Some people send me some questions via email, and as I mentioned, I'd love to hear what, your comments and questions as well. So really, I just thought we'd just start off and almost like kind of pause, take a breath after what's really been several pretty good months for most asset classes, and assess, or at least try to assess, where we are with the economy and where we might be headed. I wanted to quickly follow up on what we talked about last time when we tried to define economic quadrants in terms of inflation and growth. In November, I did predict that we'd be likely to head into a period of higher inflation. It could be due to government spending, impediments to trade, impediments to immigration. What wasn't clear, and still isn't, is whether this inflationary burst would be accompanied by high growth or stagnation. Now, looking at it a few months later, it does seem, from looking at what's been happening in the markets, that investors, very broadly defined, seem convinced that growth will be high, inflation will be moderate, albeit higher than it has been, and that interest rates are liable to increase. And stocks have, I guess based on all of that, have been pretty strong. And bonds, although they did sell off right after the election, have been remarkably stable. And that topic of interest rates and bonds sort of leads me into another area I just wanted to touch on. I guess it would be too broad to label what we're seeing the irrelevancy of the Federal Reserve, but we have definitely seen what I believe is a diminution of its impact on the financial markets. And why do I say this? Well, as economic growth has remained pretty much intact over recent months, the Fed started to signal loudly, and particularly just over the past week, that they'll be raising interest rates this year 3 or 4 times, maybe amounting to as much as a percentage point. And the market's reaction to this has been a collective yawn, really. And in years past, those kind of announcements and actions from the Fed would have shaken the stocks and bonds pretty severely. This time, nothing. And I do believe this is a positive development, and that investors seem to be paying more attention to actual economic and corporate results and not so focused on the central bank micromanagement. I do believe this is a positive, that investors are basing their decisions on more than just what a wise council of bankers and economists decides in their closed room. And that sort of led me to wonder next, well, okay, so if investors will be making their decisions on how the economy is, well, how exactly is it doing? How are corporate profits and their prospects? And truth be told, the economy continues to perform much as it has over the past 4 or 5 years, steady if unspectacular growth. Steady growth in employment, steady growth in home prices. Around the world, Europe seems to be recovering despite, the geopolitical headlines, and emerging markets have also gotten stronger. Now, all that said, the various barometers of sentiment, whether they call them consumer optimism, the surveys, and the most obvious indicator of sentiment, the Dow Jones Industrial Average, they're all showing signs of optimism that in actuality have outpaced the facts on the ground. And this is, believe it or not, even more true in Europe and places like Brazil than it is here, where just the measures of optimism among corporations and government is far ahead what the actual economic statistics would indicate. Now, for corporations, especially here in the U.S., times are good. and that's a continuation of what the situation has been. The Trump administration has so far adopted policies that can really only be construed as pro-business and pro-investor. And some of the policies that had the prospect of severely denting profits, such as mandating wage increases, breakdown of trade agreements, have seemingly moved to the back burner, or at least have been tamped down somewhat. Of course, one thing we've learned over the past 6 months to years that we must expect the unexpected, and no one, certainly not investors of the family firm or in general, should become complacent or overconfident. So with all that said, I did want to quickly address a couple of questions we got by email, and one just concerned the strategy of how we want to think about investments in an environment of rising interest rates, something we've talked about in the past. And as I was mentioning with Stacy on our staff today, she said, "Oh yes, we've been we've been calling for the rise in interest rates for 6 years now, and one of these years it will definitely happen." But it does, obviously, for some of the reasons that we outlined above, it does seem more likely this year, especially if the Federal Reserve will be increasing the short-term rates. And so the question, how do we want to think about that? What we've really tried to do to manage the risks in the bond market is just by employing bond or even bond-like investments that can respond to rising rates or inflation. And sort of the most obvious one of those are just inflation-protected bonds issued by the Treasury. They have a place in most of our client portfolios, and those bonds, they're interesting. They're not included in bond indexes, so our results differ from bond indexes, and we think that's a very good reason why they do. We also, a strategy could definitely be to emphasize shorter-term bonds, and that's something that we have done, and they're less exposed to potentially large rises in long-term interest rates or mortgage rates, if we want to think about them that way. But we always want to be careful, because we have to recall that it's not a slam dunk that even if the Fed raises short-term interest rates, that will cause longer-term rates to rise. And actually, if those very same policies of raising the short-term rates or some sort of political wild card induce an economic slowdown or outright recession, the long-term rates would actually fall, not rise, and that those bonds would therefore gain in value and would actually be the best place to be in those kind of scenarios. So it's interesting. It's not, there's always multiple outcomes that can happen from a strategy. One other question I got was about the budget and what appears to be a definite, firm decision to increase military spending. What sort of impacts would that have? As we sit here today, it's still an open question if entitlements will remain untouched or not. There seems to be a difference of opinion about that on the White House and Capitol Hill. But one thing I think does make sense when we talk about the military spending and some of the other spending, infrastructure, what have you, is that coupled with a promised potential tax cuts, this would seem pretty likely to blow out the budget deficit, something that honestly was going to happen within a decade anyway, even if we can, if we continue on the same path we're on. No one has the crystal ball on this. I would just say that despite the promises that get made to us every 2 or 4 years, at some point it seems pretty obvious that entitlements will have to be touched or adjusted. It seems the word that's now in vogue is modernized. And, we can just call those cuts, but we have various euphemisms for that now. This is obviously many years into the future, but, it just will sort of emphasize the trend that's been going on in society, that individuals have to be more and more reliant on themselves for a secure retirement. This really has been a trend that's been going on for at least the last 25 years. And it's it just is really inevitable given the increases in longevity and the cost of medical treatments and just everything else that's happening in society. So I'd like to thank everyone for their patience, for listening to my, as I said, my monologue or soliloquy, whichever word you prefer. And at this point, I'd just love to open it up and hear what's on your minds or address any questions that you have. And thank you all.